Hello, this is Scott with Ghost Trades. And as you know, I've been bullish on silver for a little while now. But let's talk about what happened on Friday. And I want to give you a good overall feel for my current outlook on silver and what to expect. So, first of all, silver is not just a precious metal, it's a critical industrial metal used in electronics, solar panels, EV batteries, medical tech, and more. That industrial demand alone is massive and growing every year. At the same time, global silver supply has lagged behind demand for years, 5 consecutive annual deficits through 2025, creating a structural shortage. And we've got a huge supply shock going on right now. On January 1st, 2026, China implemented new silver export licensing rules that effectively disqualified most exporters. That left exports controlled by a small number of state-owned firms. China accounts for 60 to 70% of global silver supply. So this policy instantly removed a huge chunk of physical metal from the global export market. This wasn't a regulation. It was control, plain and simple. Physical silver that used to flow to international buyers is now largely staying inside China for domestic industrial use, hoarding, or strategic stockpiles. I think China used this whole regulatory thing as plausible deniability. But again, it's all about control. So silver inventories, especially in key hubs like the Shanghai Futures Exchange, are actively falling. Meanwhile, physical premiums, the extra amount people pay for real metal versus paper contracts, have exploded, reaching huge spreads in Shanghai and other markets. So let's quickly talk about the two silver markets. There's COMEX and there's physical reality. COMEX paper silver is futures and contracts that represent promises to deliver metal later. Actual physical silver, we're talking bars, coins, and metal in vaults or industrial stockpiles. Right now, these markets are disconnected. Paper silver prices often fall or trade lower because traders can print more contracts or unwind positions easily. Physical silver is hard to obtain, with strong premiums and actual shortages of metal available for delivery. This gap, paper versus physical, is where the real story is playing out. So, what happened on Friday? Well, silver prices experienced one of the sharpest single-day reversals in years. COMEX paper silver prices plunged sharply after an explosive rally. This retracement was driven by a stronger US dollar as markets reacted to expectations of tighter or hawkish monetary policy. So they're talking about keeping interest rates steady, maybe not aggressively cutting them. So that is hawkish monetary policy, and that was good for the dollar. Now let's talk about the profit taking and margin liquidations as leveraged positions were unwound. And this is all about technical indicators, technical factors like margin requirements, increased forced selling. So here's the price of COMEX paper silver. You can see this huge run up that we had over the last couple of months. And then all of a sudden, bam, major drop. We were way overextended technically. And with signs of the DXY, which is the dollar index, strengthening, you've got this inverse correlation. Since silver is priced in dollars, when the dollar is strong, you're going to see silver and gold fall, and vice versa. So we had this huge upward run and then this big drop. But a lot of people are going to say, all right, well, something happened similarly back in 1980. Well, let's look at the chart of what happened back in January of 1980. We had this huge run up. They call that parabolic. And then all of a sudden, bam, major drop. And look at this price action. It actually led to a further drop in silver. So is this time the same? Well, I think some things are going on differently. Back here, this was someone going in trying to corner the market. This time, we've got a physical silver and a paper silver kind of a a disconnect happening, there's still a huge demand for physical silver. But here's the key point. While the paper price collapsed, physical silver did not collapse this time. In major Asian physical markets like Shanghai, physical silver traded significantly higher, and inventories weren't being sold off in response to this huge paper price drop. This tells us what many traders already suspected. The January 30 drop on Friday, it was a paper market correction, not a fundamental decline in physical demand or scarcity. So yeah, fundamentals still point to tight markets. The global silver market has been in deficit for years, with industrial demand consistently exceeding supply. For 2025, estimates place the deficit at well over 100 million ounces. Paper does not equal metal. If you own an ETF or a futures contract, you do not necessarily own physical metal. You own a claim on it. In a structural shortage, those claims can diverge widely from actual metal availability. Companies that need silver, your solar panel makers, EV battery producers, electronic manufacturers, must source actual metal, not paper. They can't liquidate their physical supply just because the paper price drops. This relentless real-world demand puts ongoing upward pressure on physical prices, even during paper price oscillations. Okay, so what's going to happen next? Nobody knows for sure, but I think there's two dominant scenarios that could and should guide your thinking and positioning. First of all, if the US government shuts down, short term, this fear is going to drive money into the dollar because geopolitical risk moves money into the dollar because the dollar is still the stable currency out there. So this is geopolitical risk, basically. Initially, money flows into the dollar. That's going to strengthen the DXY temporarily, and this could cause paper silver to drop sharply. Part of what happened on Friday is, with the Fed hawkishness, money moved into the dollar went up. All these institutional algorithms start selling silver because they see the dollar strengthen, and everybody is leveraged, over leveraged right now on silver. It's had this nice run up, and I think the writing is on the wall that there is a supply shortage with silver. And so that caused a cascade of selling, and it was huge. It was huge on the paper silver. We could see, something like this happen even stronger. Short term, the dollar rises, those algos keep selling, and silver could drop sharply. Now, I think that's going to be a good buying opportunity because medium term, it might be a few days, who knows, it might be a few hours, but there's going to be a loss of confidence in the U.S. fiscal stability, and loss of confidence in the U.S. government moves money out of the dollar. So initially the money goes into the dollar and then it comes right back out. And that historically supports precious metals. So if money is moving out of the dollar, bam, silver rebounds. So the result is going to be sharply higher volatility in the short run, followed by strong upward pressure on silver prices later in the month and all throughout the year, in my opinion. Now, if the government shutdown is averted, confidence returns to the markets. The dollar stabilizes, and that reduces downward pressure on paper silver. This underlying supply deficit and industrial demand will still remain intact, and as a result, silver prices should resume at an orderly upward trend. So we could get a nice bounce from where we're at right now without any kind of further sharp drawdowns. And this is going to be kind of a less chaotic than the shutdown scenario, but still, both scenarios, in my opinion, are bullish over the long haul. So my fellow ghost traders, what do you do? How do you handle all this information? Well, pay attention to the DXY. Again, that's your dollar index. And since silver is priced in dollars, it's sensitive to dollar moves. So watch what the dollar is doing. Own physical metal if you want true scarcity exposure. I think that's a good investment long-term. Paper money, well, if there's a huge disconnect with physical silver and there is a huge rush to demand delivery of physical silver and that can't happen, then there could be a loss of confidence in paper silver, and that could crash, even though physical silver remains scarce and the price keeps going up. ETFs and futures, now they can be useful for trading, but they don't guarantee delivery, especially during structural shortages. Prepare for volatility. Big macro events like Fed policy, currency moves, political risk, they can move paper prices sharply, even when physical fundamentals remain tight. Use risk management, as always. I know we harp on that all the time, but use risk management and position sizing accordingly. And then also think in terms of structural trends. The industrial demand trend, so solar, EV, electronics, it's not going away. New mines. A lot of people are saying, well, maybe all these mining companies, they'll just go after it and they're going to try to mine silver like crazy. Well, yeah, but it takes years to come online. And that means tightness could persist throughout the entire decade, possibly. So the mining companies aren't going to all of a sudden produce a whole bunch of extra silver and save us from this huge deficit. So to summarize, I just want to say that the silver market might not necessarily be broken, but it's telling us something important. Physical silver is scarcer than paper markets acknowledge. Structural supply deficits and industrial demand are real and growing. The January 30th Friday paper price crash was a market mechanism, not a fundamental breakdown in demand. And long-term supply-demand dynamics support higher prices, in my opinion, but there's going to be volatility along the way. I'm Scott, and thanks for listening.